Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 9th, and today the market did that thing where it hears one data point and suddenly rewrites the entire rate cut fan fiction.
I love when the market gets dramatic. One number drops and everyone's like, new personality unlocked. Okay, what are we unpacking today? Rates, oil, and a currency doing parkour.
Story 1. Traders are seeing almost no chance of a Fed cut this month after fresh labor data. The setup. Treasuries fell, meaning yields rose, as markets concluded the economy isn't cooling enough to justify an immediate cut.
Wait, I thought the jobs headline was softer. How do we get fewer jobs and then higher yields? That feels like ordering decaf and getting espresso.
It's basically like your car's speedometer and your engine temperature disagreeing. Payroll growth can slow, but if unemployment falls more than expected, it signals labor demand is still tight. Tight labor can keep wage pressure and services inflation sticky, so the Fed stays cautious.
So the market heard unemployment down and went, cool, the Fed's not saving my variable rate debt. Awesome. What's the normal person translation here?
3 impacts. 1. Borrowing costs stay higher for longer. Mortgages, auto loans, credit cards feel it. 2. Bond prices can drop when yields rise, so long-duration bond funds can wobble. 3. Equity valuations, especially growth stocks, get more sensitive because future earnings are discounted at higher rates.
Okay, actionable. If someone's sitting there with cash, bonds, and stocks, what's the move without pretending we can outsmart Jerome Powell's calendar?
Think rate risk hygiene. If you need stability, consider a short-term treasury ladder or a money market fund for yield without big price swings. If you hold bond funds, know your duration. Shorter duration usually means less sensitivity. And for stocks, diversify. Don't let your whole portfolio be a single bet on rapid cuts.
Speaking of things that move markets fast, oil. I saw the headline, oil held its biggest gains since October because Iran protests escalated and there were threats flying around. Is this actual supply problem, or everyone panics and buys barrels emotionally?
Mostly risk premium. Price moves on the probability of disruption, not only confirmed disruption. Imagine airline tickets. Prices jump when storms are forecast, even before flights are canceled. With oil, geopolitical headlines can add a fear surcharge because supply chains are tight and inventories can't instantly expand.
So we're paying for maybe. Love that. How does that flow into inflation and the Fed story we just did? Because my brain wants one unified theory of my grocery bill.
Energy is a classic inflation accelerant. Higher oil can raise gasoline and transport costs, which can leak into broader prices. If energy-driven inflation expectations rise, it makes the Fed even more careful about cutting because they don't want inflation re-accelerating while the labor market still looks firm.
Action step time. Do normal people hedge oil? Or is the hedge just drive less and cry quietly?
For most households, the best hedge is budget resilience. Keep an emergency buffer and avoid over-leveraging. For portfolios, modest diversification into energy or broad commodity exposure can reduce the shock from energy spikes, but size it carefully. The goal is stability, not turning your retirement account into a barrel of crude cosplay.
Now let's go global. The rupee crossed 90 to the dollar, and the question was, why didn't the RBI just defend a price band? And the answer was the impossible trilemma, which sounds like a Marvel movie, but with spreadsheets.
The trilemma is real. You can't simultaneously have a fixed exchange rate, free capital flows, and independent monetary policy. You only get 2. If a country wants to target domestic inflation with its own interest rate policy and still allow capital to move freely, the currency has to float more.
So defending the currency is like trying to hold a beach ball underwater. You can do it, but you're spending reserves and energy, and it pops up somewhere else, like inflation or growth.
Exactly. If the RBI aggressively defends a level, it may have to raise rates or burn FX reserves, both of which have costs. Letting the rupee adjust can protect policy flexibility, especially if the priority is inflation management rather than a specific USD INR number.
And for listeners, if you're traveling, importing stuff, or investing in emerging markets, currency moves are not background noise. They're the whole soundtrack.
Quick recap. 1. Labor data pushed markets to price fewer near-term Fed cuts. Watch rates and duration. 2. Oil rallied on geopolitical risk premium. Energy can feed inflation expectations. 3. The rupee story is a clean lesson in the impossible trilemma. Currencies move when policy priorities collide.
If you learned something, subscribe and send this to the friend who thinks the Fed pivot is a guaranteed annual holiday. Also, please stop taking portfolio advice from vibes and a single headline.
And if you want a simple checklist, keep a cash buffer, know your bond duration, and diversify across sectors so one macro surprise doesn't dominate your year. We'll be back with the next briefing.